What is private credit and why it's exploding in 2025? Private credit is one of the fastest growing corners of finance in 2025, making headlines and attracting billions from major investors. But what exactly is it, and why is it exploding now? Let's break it down. Don't forget to subscribe and ring the bell so you never miss the latest from Bright Sense. What is private credit? Private credit, also known as private debt, refers to loans made by non-bank lenders such as investment funds, asset managers, or private equity firms directly to companies. These alternative lenders offer financing that's often faster and more flexible than traditional banks. Most private credit activity today centers around direct lending, typically senior secured loans to mid-sized businesses. These loans offer relatively high yields while providing protection through collateral. Instead of going to a big bank and jumping through hoops, they strike a deal with a private lending firm that can offer customized terms, sometimes in just a few weeks. This space has been around for a while, but over the past few years, and especially in 2025, private credit has exploded in popularity. And there's a good reason for that. Why are companies choosing private credit over banks? Well, there are a few reasons. 1. Stricter regulations. After the banking turbulence of the early 2020s, regulators tightened the rules on how much risk banks can take on. That made it harder and slower for businesses to get large or complex loans approved. 2. Speed and flexibility. Private credit lenders don't have to follow the same rigid rules. They can underwrite loans quickly and customize the terms to fit exactly what the borrower needs. 3. Complex needs. Companies undergoing restructuring, acquisitions, or refinancing often turn to private lenders who are more accommodating. 4. Expanding market. In addition to classic leveraged corporate lending, the private credit market is growing to include asset-backed finance, real estate, and infrastructure. Why is private credit booming in 2025? 1. Higher yields. Central banks worldwide raised interest rates over the past couple of years to fight inflation. That's made borrowing more expensive, but it also means returns on loans have gone up. Private credit loans today can yield anywhere from 8% to 12%, sometimes even more. In a world where public bonds and dividend stocks aren't paying as much, investors are jumping into private credit to boost returns. 2. Banks lending less. Traditional banks are pulling back, especially from riskier or more complicated loans. That created a huge gap in the market, and private lenders saw a massive opportunity to step in. Some banks are even partnering with private credit firms instead of competing with them, essentially outsourcing the lending to avoid regulatory headaches. 3. Institutional inflows. Massive institutional investors, like pension funds, insurance companies, and even sovereign wealth funds, are pouring billions into private credit. Firms like Blackstone, Ares, Apollo, and KKR are launching mega funds dedicated just to this space. To give you an idea, Blackstone's private credit arm is now managing over $300 billion. That's not small change, that's serious money. 4th, borrower demand. Businesses still need capital, whether they're expanding, restructuring, or making acquisitions. Even in a more cautious economy, the demand for credit hasn't gone anywhere. Private credit gives companies a reliable funding source, especially when traditional loans are harder to get. 5th, institutional investor appetite. This trend is being supported by massive institutional inflows. For diversity and higher returns than traditional fixed income, insurers, sovereign wealth funds, and pension funds are now investing more in private credit funds. 6. Innovation and expansion. In addition to corporate loans, private credit now encompasses asset-based finance, infrastructure, real estate lending, and in certain niche sectors, consumer lending. 7. Growing middle-market companies. Many mid-sized companies don't have easy access to public markets or big bank loans. They need financing to grow, acquire other businesses, or restructure debt. Private credit funds specialize in lending to these companies, fueling their growth and expanding the market for private credit. 8. Innovation in financial technology. Technology is helping private lenders assess risk and manage loans more efficiently. Platforms powered by AI and data analytics make it easier to identify creditworthy borrowers quickly, speeding up deals and reducing costs. Market size. The global private credit market is worth an estimated $1.7 trillion in 2025, and it's projected to hit $3 trillion within the next 5 years. In the U.S. alone, private lenders now account for more than 60% of all middle-market lending. That's companies with revenues between $10 million and $1 billion, a huge segment of the economy. And we're not just seeing growth in the U.S., Europe, Asia, and even Latin America are seeing a spike in private credit activity. As banks around the world tighten their lending, private funds are stepping in to fill the void. Real-world examples. A tech startup wants to acquire a competitor. It needs $150 million in financing, but it's not profitable yet, so banks aren't comfortable lending. A private credit firm steps in, offers a structured loan, maybe adds an equity kicker, like stock options, and closes the deal quickly. Or take commercial real estate. Office buildings and malls have had a tough time post-pandemic, so traditional lenders have stepped away. Private credit firms are jumping into this space, offering loans with higher interest but more flexible terms. These are deals that wouldn't have happened 10 years ago, but in today's market, they're common. Risks of private credit. 1. Illiquidity. Investments are locked up for years. There's no quick sell button. 2. Default risk. Borrowers are often lower rated or unrated, increasing the chance of non-payment. 3. Transparency. Since these deals aren't traded publicly, full details may be unavailable to casual investors. 4th, leverage. Many private credit funds use borrowed money to boost returns, which can amplify both gains and losses. 5. Regulatory risk. As this market grows, global regulators are increasing scrutiny due to potential systemic implications. Accessibility to retail investors. Right now, most private credit funds are limited to institutional and accredited investors. But that's starting to change. We're seeing the rise of interval funds, private credit ETFs, and even tokenized private debt offerings that aim to bring private credit to the retail crowd. For example, some publicly traded funds now provide exposure to diversified pools of private credit, giving everyday investors a taste of the action, with lower minimums and more liquidity. Still, it's important to do your homework. This space is complex, and not all funds are created equal. How will the future be shaped by private credit? Private credit isn't just a niche market anymore. It's becoming a cornerstone of modern finance. Its growth is reshaping how companies get funded, offering new paths outside the traditional banking system. For investors, understanding private credit is more important than ever, especially in a world where traditional investments face challenges from rising rates, inflation, and geopolitical uncertainty. Private credit isn't just a trend, it's reshaping the way capital flows through the global economy. With interest rates staying higher for longer and traditional banks pulling back, private credit is filling the gap. Whether it's helping a business grow, refinance, or stay afloat, these loans are playing a huge role in 2025's financial landscape. For investors, it offers an exciting opportunity, but it's not without risks. Like anything in finance, understanding the fine print is key. Hopefully, this gave you a clear picture of what it is, why it's growing so fast, and what it could mean for the future of investing. If you learned something new, drop a like, subscribe to the channel, and hit the bell so you never miss a video. Thanks for watching, and I'll see you in the next one.